Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we're sharing three stories. First, the UK's Sizewell C nuclear plant cost just exploded to £38 billion. We'll break down a new US partnership with firm X Energy to build modular reactors and race against China's operational TRPM. Second, while the Nasdaq is up 15%, the rally looks fragile. We'll dig into why United Airlines stock soared 41% as retailers like Target collapse and what Treasury Secretary Scott Bessent's warning means for the Fed. And third, we're diving into global shipping, where cybercriminals now demand $3.2 million ransoms. We'll explain this new cybersecurity tax and what it means for carriers like Zim and Costa Mare. The most unexpected news in the finance world today has to be the price tag for a single UK energy project, which just exploded from £20 billion to a staggering $38 billion. That's what's happening with the Sizewell C nuclear plant. And in the face of that spiraling cost, the UK and US are now rolling the dice on a radical new plan. The core of the UK's energy dilemma is something called baseload power. Think of it as the minimum electricity the grid needs 24/7. Traditional nuclear is perfect for this, but as the UK pushed for more green energy, it became reliant on intermittent sources like wind and solar. The wind doesn't always blow and the sun doesn't always shine, creating instability. The UK's national grid has warned that even with massive renewable capacity, there will be times they can't meet demand. A credible nuclear pipeline guarantees that stable power, which in turn makes the country more attractive for energy-hungry industries and could ultimately lower the total cost of the green energy transition. So, they've forged the Atlantic Partnership for Advanced Nuclear Energy, a landmark deal with one explosive goal: to slash the regulatory approval time for new nuclear reactors from 4 years down to just 2. Now, this partnership isn't just about energy security, it's also about a global technology race. Actually, the West is playing catch-up. China has already connected the world's first fourth-generation modular nuclear reactor, the HTRPM, to its grid and started commercial operations in December 2023. By comparison, the American company X Energy, which is central to this UK deal, is targeting deployment in the early 2030s. The winner of this race will not only control critical energy infrastructure, but also set the global standards for this new technology, creating a whole new arena for US-China competition. The first major play is a deal for up to 12 advanced modular reactors in Hartlepool. The concept is a game changer. Think of them as flat-packed power stations built in a factory and assembled on-site. US nuclear group X Energy and Centrica, the owner of British Gas, claim this fleet has the potential to power 1.5 million homes. Of course, there's a significant hurdle. This technology is so new, there are almost no commercial examples operating anywhere in the world. This has critics like Greenpeace's chief scientist sounding the alarm, warning this will lead to higher bills from nuclear's relentlessly spiraling costs and more carbon emissions from inevitable construction delays. And there's some hard data that supports this concern. A massive labour shortage in the UK means the construction industry needs to find over 250,000 new skilled workers by 2028. This skills gap is already causing wage inflation in the past year. Wages for skilled trades like steel workers have jumped over 11%. For huge, complex projects like nuclear plants, this shortage of specialised workers can directly lead to the very delays and budget overruns that critics are worried about. But the industry is firing back. Centrica's CEO argues that the only way to get better, cheaper and faster is to build more often, claiming these smaller, repetitive reactors are the answer. This idea of practicing until you get it right isn't just a hopeful slogan. It's based on a powerful economic principle known as the learning curve or Wright's law. It states that for every doubling of production, costs fall by a predictable percentage. We've seen this with solar panels, whose cost has fallen by over 99% since the 1970s. The hope is that by mass producing these modular reactors, the nuclear industry can finally get on a similar cost reduction curve, making it a deflationary energy source instead of a financial drain. It's a high stakes conflict. The UK's nuclear energy output has collapsed from 25% of its electricity to just 15%, while dozens of countries have pledged to triple global nuclear capacity by 2050. The real litmus test will be the ratio of public to private funding. If private investors are hesitant, the UK government might be forced to cover the costs with more public debt. If the first few projects face the same old delays and cost overruns, it could scare private capital away for a generation. It leaves everyone to wonder, is this flat pack nuclear strategy a brilliant solution, or is it just the next multi-billion-dollar gamble destined to fail? Speaking of high-stakes gambles, the stock market is making a huge one of its own right now. The Nasdaq just rocketed 15% in the last 3 months, with the Nasdaq 100 close behind at 12%. Both indexes, along with the S&P 500, are smashing through all-time highs. However, if you zoom out, you'll see another layer to this story. These record highs might be masking an underlying weakness. It comes down to a concept called market breadth, which basically asks how many stocks are actually participating in this rally. Recent data shows that the market's advanced decline line is not keeping pace with the major indexes. Such narrow market leadership, driven by just a handful of mega cap stocks, is often a sign of a fragile rally that has historically preceded market corrections. While the broad market celebrates, the real drama is happening inside specific sectors. Take the airlines. United Airlines stock has soared an incredible 41% in just 3 months. Its strong performance suggests consumer demand for services, particularly travel, is more resilient than expected. While that's great for airlines, it's a headache for the Federal Reserve, as it could mean services inflation remains stubbornly sticky, potentially forcing it to keep interest rates higher for longer. And now, its CEO, Scott Kirby, is scheduled to speak live. The stakes are high, especially with the stock still 10% below its 52-week peak and its rival, American Airlines, lagging a staggering 34% from its own high. The retail sector presents a fascinating duality. We're seeing companies like American Eagle Outfitters exploding 51% in a single month, with Build-A-Bear Workshop, and Macy's also up 36%. At the same time, giants like Target, Dollar Tree, and Groupon are at the absolute bottom of the pile. A massive split is tearing the retail world in two. This divergence reflects a deep split in consumer spending, a trend economists call bifurcation. High-income households are continuing to spend, especially on luxury goods and experiences, which helps companies like Macy's. Meanwhile, low-income groups are cutting back due to economic pressure, which directly explains why discount retailers like Dollar Tree are struggling. This trend is a critical signal of growing credit stress for a large part of the economy, and it makes the Fed's job much more complicated. So, with the market this hot, all eyes are turning to Treasury Secretary Scott Bessent, who is set to go on the record about interest rates. His words are crucial because they touch on a growing risk known as fiscal dominance. Essentially, it's a scenario where the government's massive borrowing needs, driven by large budget deficits, start overwhelming the Federal Reserve's monetary policy. The sheer volume of government bonds being issued could force long-term interest rates higher, regardless of what the Fed wants to do. With US federal debt projected to keep rising, this risk is becoming more real and could make it much harder to control inflation. With indexes at record highs and the corporate world fracturing between massive winners and losers, the real question is, will the Fed's next move add fuel to this fire, or will it be the one thing that brings this entire rally to a screeching halt? We were just talking about the pressures facing the Fed. Well, a new hidden driver of inflation is emerging from a place most people don't think about. The high seas, the new going rate to hold global trade hostage, $3.2 million. That's the average ransom now being paid by global shipping firms to cyber criminals. And the cost just to deal with an attack has doubled in the last year alone to over $500,000. This isn't just a problem for shipping companies, it's a new hidden driver of inflation. These rising costs, from ransoms to insurance premiums, are creating what economists call new supply chain friction. That friction translates into higher shipping costs, which eventually get passed down to consumers, threatening to push up prices and complicate efforts to control inflation. This is a direct threat to the system that moves 80% of all world trade. The number of cyber attacks on the shipping industry has exploded, shooting up from just 10 incidents in 2021 to more than 60 last year. The attackers are a mix of sophisticated players, from organised criminal gangs to state-sponsored actors in Russia, China, and Iran. Interestingly enough, this can also be a form of grey zone conflict. State-sponsored cyber attacks on commercial shipping allow a country to create targeted disruptions and signal geopolitical intent, all without triggering an actual military response. It's a way to wage a trade war outside of formal tariffs. For Chinese-speaking audiences, this has particular resonance. China has built a dominant global position in shipbuilding and maritime logistics, meaning any disruption to these supply chains has significant implications for its own economic stability. Here's where it gets interesting. The core of the problem is a fleet where the average cargo ship is 22 years old, running on piecemeal digital systems. But the situation is more complex than just old tech. The issue is what experts call the digitalization dilemma. It's not just about the old ships, but about how they are being hastily and unevenly upgraded. Believe it or not, new technologies are actually creating more vulnerabilities. Satellite internet services like Starlink, designed to bring ships online, are also opening new doors for hackers. Even sensors installed to monitor emissions are becoming potential entry points for a full-scale attack. A single successful breach on a major port's outdated technology could now trigger cascading failures across global trade. The threat is no longer theoretical. A container ship recently ran aground in the Red Sea after a suspected GPS spoofing attack sent it off course. And when a breach happens, the negotiations are tense, with lawyers communicating with hackers through encrypted messages to negotiate multi-million-dollar ransoms. The long-term economic reality is that these escalating costs for cyber defense, insurance, and ransoms are becoming a permanent structural cybersecurity tax on the entire industry. The maritime cybersecurity market is projected to skyrocket from $1.65 billion to nearly $7 billion by 2033. This isn't a one-time cost. It's a new, ongoing expense that will likely establish a permanently higher baseline for global freight costs. Looking ahead, it's worth keeping an eye on the stock prices of major shipping lines like Zim and Costa Mare, as they may show volatility. Also, watch for rising maritime insurance premiums, which are a leading indicator of how the industry is pricing this risk. With 80% of everything you buy, sell, and use floating on the open ocean, the question is no longer if the next major disruption will hit, but what it will cost when it does.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.